Good morning, everyone. This is Jonathan Pollard of Pollard Financial Coaching and Gen Y Financial Freedom coming to you this Tuesday, November 4th, 2014. And today's video topic will be a little bit longer than normal, but it is about the stock market and an overview of its inner workings. So let's jump right in. So what is a stock? A stock is a piece of a corporation. It's ownership in a business. That is the correct way to think about stock investing. You shouldn't just think of a stock as a piece of paper or an electronic debit. Okay? Why do stocks exist? Well, let me just give you a little brief background. When a company would like to raise money, it can do one of several things, but it usually does one of two things. The first thing it can do is issue debt to people outside of the company, right? So it can say, "Hey, person A, Miss A, please give me several $1,000s so I can help my company grow." Right? Miss A in this instance would be a creditor of the company. She would also be a bondholder, but she's a creditor. And what that means is that in the event that the company goes bankrupt, Miss A has a legal claim to the assets of the company. So the company is required legally to make her whole in the event that the company goes bankrupt. And the total amount she can lose in her investment is what she put up, whatever she lent to the company, and the total amount she can gain is the amount that she put up plus whatever interest the company promised to her. A company can also issue shares to raise money. This is done through what's called an initial public offering. Now, after an initial public offering takes place, a company does not have any duty to return the money that the investor placed in the company back to the investor. Outside of any rules imposed by the Securities and Exchange Commission, the company does not have an obligation to return the investor's investment, right? So theoretically, a person can lose when he or she invests in shares. Theoretically, a person can lose his or her entire investment. But the flip side to that, and this is why people invest aside from wanting to beat inflation, is that you can theoretically make an infinite return on your money. Okay? So those are two important concepts to understand. All right? Now, the next concept that I want you to understand is the concept of a market. All right. The stock market is just like any other market. It's composed of buyers and sellers. Now, there are some intermediaries, such as clearing houses and brokerage houses. And I'm not going to discuss the intricacies of those today because that's beyond the scope of this video and it would take too long. But I want you to think of being at an auction house such as Christie's, where you're buying fine art, or you're buying custom guitars or custom cars and whatnot, right? So there's a bidder, right? There's a buyer, and then there's someone who's selling it. Now, there's a famous quote from a very famous investor named Benjamin Graham that says, in the short term, the stock market is a voting machine. In the long term, it is a weighing machine. Now, I know that that might sound extremely cryptic, and you might say, Jonathan, what does that mean? Well, I'll explain it to you. It basically means that in the short term, stock prices are subject to the desires and whims of investors. So, for instance, when a company comes out with a new product, let's say Apple, right, and it hasn't necessarily reported its earnings to the general public, but investors see that a company is coming out with a new product and that a lot of people are frequenting a particular store like Chipotle, or buying a whole bunch of iPhones, or buying a whole bunch of bags from Michael Kors. Investors see that money is flowing in to that particular company, so they might want to bid that stock up because they think that the influx of customers to that company will make the stock more valuable, and in some respects that is true. However, that assumption that just because a company has a whole lot of customers and people are flocking to it and buying its products doesn't mean that it's a profitable company. Right, but in the short term, investors will see those money flows into a particular company and start to bid the stock up and make it worth more, right? So the stock market is all about supply and demand. All right. On the flip side of that, as Benjamin Graham said, in the long term, the stock market is a weighing machine, right? So even though investors might think, oh, some new fancy product is going to make companies super profitable, in the long term, investors always bring a company's stock price in line with its business fundamentals. So if a company is flush with cash, if it has a whole lot of money on its balance sheet, if it's producing earnings, and it doesn't have a whole lot of debt, stock investors are going to push that stock price up in the long term. And even though the stock price might be depressed, it's going to come in line with the value, the true value of the company. Whereas in the short term, investors might not necessarily notice it. Okay. Another concept that I want you all to understand is that there are different types of stocks, and you need to understand a little bit of technical jargon. Okay, so the first type of stock there is a large cap stock. What does that mean? That's usually a company that is maybe 5 billion, has a market capitalization of $5 billion or more. Now, what is market capitalization? It's just stock price times the number of shares outstanding. So just for practical purposes, if you have a stock price of $2 and you have 100 shares outstanding, then the market capitalization of that particular stock is $200. Now, obviously, I just gave you a number such as billion, and usually company sizes are measured in millions and billions, right? So a large cap stock is usually a stock that's more than $5 billion. A mid cap stock is a stock that has a company size of in between $1 billion and $5 billion. A small cap stock would be a stock that has a market capitalization of $1 billion or under. I'll give you an example of each of the following. A large cap stock would be a company like Coca-Cola, American Express, Facebook, Apple. A mid cap stock would be a company such as GoPro. If I'm not mistaken, GoPro is a company that makes action sports cameras. An example of a small cap stock, I can't think of any off the top of my head, but you can look on Yahoo Finance to find some. And please excuse my my ignorance with regard to small cap stocks, or with regard to specifically what companies constitute a certain size stock. The last thing that I'd like to discuss with you with regard to understanding, the second and the last thing that I'd like to discuss with you with regard to understanding the stock market is that there are certain documents that investors look at to make their decisions. Okay, those documents are documents that are required by the Securities and Exchange Commission. They're called quarterly reports or annual reports, or just press releases, and their technical names are a 10Q, a 10K, and an 8K. A 10Q is a quarterly report that's issued by a company. It's mandated by the Securities and Exchange Commission, which is a governmental body that requires all companies report their earnings in a certain way every 3 months. A 10K is an annual report that a company is required to release by the SEC, and an 8K is just a press release. Anytime a company makes a major acquisition or does something that materially will affect the earnings of the company, is required to disclose it to the public. And also, investors can learn about a company through what's called conference calls. I don't have any particular websites to give you right now. However, if you would like to look up, where you can find conference calls and 10Qs, 10Ks, and 8Ks of various companies, you can just Google all of these things, and they will pop up. Just type in the company name and then put 10Q, 10K, or 8K behind it. Another good source is Yahoo Finance. The last thing that I want to talk to you about is the fact that I encourage you all to think for yourself when investing. I know a lot of times I espouse the usage of investment newsletters. However, there's no substitute for knowing about your own investments. So if you want to get started learning about truly how to invest I can recommend a few good books for you. One is Peter Lynch's One Up on Wall Street. That was one of the first books I read. Another book is How to Make Money in Stocks, the Warren Buffett Way. Another one is How to Value a Stock by Gary Gray. And if you have any further questions or any issues with the mechanics of how things work or anything that I described, please feel free to send me a message at jcp18200@yahoo.com. Thank you all so much for watching. I hope it was informative, and enjoy your day.